This year, foreigners have been net buyers of Brazilian equities to the tune of 24 billion reais, local currency, a year to date, and with 45% of this taking place from May onwards. So it looks like at the margin, indeed, Brazil and other places in the region are being beneficiaries of the rotation trade.
Hi, everyone. I'm Rob Rowe, U.S. Regional Director of Research at Citi. Welcome to the Research at Citi podcast. With me on the podcast today is Andre Mazini, who is the head of our LATAM equity research effort. And I guess this is a really timely podcast because we're also having our Citi Brazil Equity Conference that starts tomorrow, but it's going to be covering the LATAM region as well. And so it's a timely time, I think, Andre, to talk about LATAM markets. Welcome.
Thanks, Rob. Very excited to be here. Excited for the conference starting tomorrow as well. 2 days. We have 100 strong companies attending and a lot of investors as well. So good to be here with you.
That's great. I wish I could be down there. I got waylaid again, but I wish I could be down there. Let's talk. When we talk about LATAM markets, I mean, they've always had a certain intrigue, right? For potentially high returns, also potential high volatility, and often seen for having diversification benefits as well. But why don't we talk a little bit about the stock markets in the region and how they compare in terms of valuations with one another, be it today and versus their historical averages?
Yes, sure, Rob. Perfect. So stock markets in the region have performed pretty well this year, with the Chile and Colombian indices up 21% year to date. Mexico is up 17% and Brazil 14%. This is in local currencies. The performances are actually significantly better in US dollar terms, as most local currencies have appreciated in value this year. So in USD terms, actually, the EWZ, which is the local market in USD terms, that's up 24% for Brazil. The Brazilian index, the Bovespa, it trades at 8.3 times forward PE. That compares to 12 times for Chile and Mexico, 13x for China, while India, the US, and the UK all trade above 20x. So we acknowledge Brazil's equilibrium interest rates are higher than most of other geographies, which this could justify this lower PE you just talked about. However, Brazilian companies are delivering nice earnings momentum. Results have been great, if you will, for the first Q, which are out. And the companies as a group, they are deleveraged as well, different than in prior cycles. So this could justify some multiples expansion. So as we said, the 8.2x Brazil trades is one standard deviation below the 20-year historical average. And most of the regions are actually trading above their historical averages. The US, for instance, is trading at the 22x we mentioned. This compares to a 19x historical average, 10-year average for the US.
Will policy rates in Brazil also provide a fillip going forward or provide some help on those returns going forward? Is the central bank essentially in a monetary easing mode?
Good question, Rob. Actually, the Central Bank of Brazil, let's call it post-COVID times, they were kind of contrarian, air quotes here, in the sense that when the world was easing rates, the Central Bank of Brazil would be tightening rates and the other way around. So the Central Bank of Brazil actually just hiked rates for what seems to be the last time just last week. So nominal rates right now are at 15%, 15% for Brazil, which is pretty high, even compared to Brazil's historicals, which are of higher rates, as we mentioned. But the central bank, they were very clear, giving, if you will, a forward guidance that they're not going to be hiking it anymore. They're just going to be leaving it at 15% for some time. Economists are debating for how long that will be. Some economists think it's end of this year. You might have some cuts or beginning next year, but there's no more hiking going on. This is what the forward guidance is saying. And then some cutting, be it end of this year or beginning of next year, which could be a catalyst when and if the central banks start cutting.
Now, as you said previously, Andre, the returns in a lot of these markets have been really good. What do you say are the main drivers of the global rotation trade, let's call it? How can some of the countries in the region benefit from it, but also what would you say are the drivers of that?
Yeah, sure. So first of all, the region is compared with global indices is kind of on the smaller side, right? The US, as an example, accounts for 70% of most global benchmark indices, while Brazil, which is the biggest market in the region, represents just 4% of the MSCI Emerging Markets Index, with other Latin countries accounting for even less than that. So any small change to US allocation by global investors can really move the needle for a market like Brazil. Furthermore, we think Latam has less geopolitical issues than a couple of other emerging markets. For instance, China, the trade war with the US is probably going to be long lasting. India is a rather expensive market and also has geopolitical tensions with Pakistan. And it trades at 20x earnings India, right? So another ballpark there in terms of valuations. Russia out of the radar of various investors. So all this combined, this mosaic may make the region beneficiary of this global rotation trade you just mentioned. And lastly, on this theme, we've seen it actually, at least in Brazil. This year, foreigners have been net buyers of Brazilian equities to the tune of 24 billion reais, local currency, year to date, and with 45% of this taking place from May onwards. So it looks like at the margin, indeed, Brazil and other places in the region are being beneficiaries of the rotation trade.
Do you think that will continue? Is that dependent upon things like how the tariff negotiations go on? Or do you think, in a sense, that the region has its own legs in terms of potential market returns?
Yeah, for sure. Certainty around tariffs will definitely be something that may make this rotation trade. Maybe talking about like the trade deals that the region has. Of course, the USMCA is in place for most goods, with the exception of cars, steel, and aluminum. And now I'm talking only about North America, of course,
Right.
Mexico, Canada, and the US. So cars exported from Mexico into the US, they are being hit with a 25% tariffs on their non-US content. But we estimate that the average Mexican car actually has 40% US parts. So the ultimate tariff hitting these cars are around 15%, not the 25% we mentioned. And the US Commerce Department actually has a portal, pretty neat, in which investors can see car by car what's the US versus non-US content of each Mexican car. And it's
Wow.
sometimes counterintuitive. For instance, the US content of Mexican produced Nissan Pathfinder is 50%, and a Ford F-150 has just 45%, a little bit less US content for a Ford F-150, both produced in Mexico, but the F-150 having less US content. So, sometimes it's counterintuitive.
Right. And I do want to cover Mexico in a sec, but I also want to think a little more about LatAm markets from the standpoint of which countries in particular are perhaps less correlated to developed markets or even potentially less dependent on them that would serve as a great diversification in terms of overall asset allocation.
Yeah, that's a great question, Rob. So, at least looking at the short-term window, talking about this year, which countries have been less correlated. So, the trading history of this year will show that the Mexican market was actually uncorrelated almost. And what we say that, so on Liberation Day, which was April 2nd, most global markets went down pretty precipitously after the event, after April 2nd. And the Mexican market actually went up after April 2nd. So, this year, Mexico was pretty uncorrelated, provides this diversification benefits we were talking about, because again, Mexican, they were excluded from the reciprocal tariffs when a bunch of other countries actually got hit by tariffs. Brazil had a 10% tariff, which is on the lower side, because actually Brazil has a deficit vis-a-vis the US. So the US has a surplus versus Brazil, but there were no reciprocal tariffs for Mexico. So that market went up. And talking maybe more long term about the region as a whole, the markets here, they're very reliant on commodities for sure. So if you go back to the early 2000s, the Brazil index was composed 50% of commodity stocks. Now it's less than a third. I mean, still a lot, but way less than it used to be in the 2000s. So I think this diversification into other sectors of the economy, industrial companies, banks, what have you, tends to bring this diversification benefits as well and make the region a little bit less exposed to global volatility. Of course, no country is an island, but it's being more diversified through the years.
And going back to Mexico, obviously that's a first or second largest economy in the region. How do you see the trade relationship with the US? How would that affect the Mexico stock markets? And what do you think are the milestones we need to watch for as we go forward?
Yeah, this is table stakes for Mexico, right? I mean, the trading relationship between Mexico and the US is huge, super important for Mexico. 80%, 80 of Mexico's exports go to the US. So an old saying would say that when the US sneezes, Mexico catches a cold. There's some truth to that, but I think less and less so, maybe through time, but it's still super important. So, of course, NAFTA is the old trade deal that we can even talk a little bit about the history of NAFTA. So it's a long-standing trade deal. NAFTA was initially proposed by President Reagan, being influenced by the writings of Milton Friedman back in the days, and then NAFTA was negotiated the first time around by H.W. Bush and ultimately signed by Clinton in 94. So this regional integration has been around for a long time. The successor of NAFTA is the USMCA that was signed in 2018 by then Presidents Trump, Trudeau, and Peña Nieto in Mexico. And the USMCA was primarily a modernization of NAFTA, namely concerning intellectual property and digital trade, so spheres of the economy which were not around back in 94. There's a stipulation for the USMCA, which is in place right now, to be reviewed every 6 years by the three nations. And the limit for the next renegotiation is July 2026. We think the USMCA renegotiations may start as early as October 1st this year, 2025, so ahead of schedule. And most investors have seen this development as positive, as it may de-risk any headline risk related to not having a trade deal, but we don't think that's going to be the case. And we actually ran a survey asking investors what will drive the Mexican market outperformance over the next 12 months. And 90% of the respondents were saying that it's the USMCA renegotiation. So that's going to be taking a lot of risk off the table, right? If it indeed happens, and we think it's most likely, that's most likely outcome. The renegotiation should take place soonish.
And Andre, here's a two-pronged question in a way. One is there was obviously a big surge in what was called nearshoring a few years ago when people felt like the trade with China and the diversification thereof, and it seemed maybe cheaper to produce in Mexico as a result of the transportation, et cetera. And I guess we saw some strong nearshoring. Do you think that trend will continue? And then the second part of that question is, what has China's influence been in the region? Because I know that China's also tried to make some forays into the region, tried to be influential there.
Sure, great questions, Rob. So we think COVID really provoked a seismic shift in how companies think about supply chains. Pre-COVID, it was all about efficiency and almost exclusively about efficiency, right? So supply chains would be located wherever it was cheapest, with little considerations to supply chain resiliency or potential disruptions, right? People were, and decision makers, companies, C-suites, they were underpricing this risk, if you will. Of course, easier to say post-fact, but this risk was being underpriced of these disruptions to supply chains. So during COVID, the disruptions, they came about, the risk materialized. So during COVID, shipping routes were severely disrupted, with freight costs going up 6x, long queues at ports, some straits like the Suez Canal being blocked for longer than a week. So therefore, post-COVID, much more attention is being given to supply chain resiliency, not so much efficiency as well, but resiliency is front and center, making the supply chains now be a little bit shorter and located in geopolitically aligned or friendly countries. So given all this, we think nothing really will beat Mexico's geography, friendly relations towards the US. So we do think nearshoring is to continue going forward. Yes. As we said, we think a likely outcome of the USMCA renegotiation may be actually the tightening of the rules of origin, which are the criteria needed to determine the national content of a product. For instance, a car has to be 75% manufactured in North America so that it's deemed to be a North American car. And it's shipped back in the day tax-free, but now I've said there's temporary taxes on autos, but that could go back to lower tariffs. So these rules of origins, they could be increased, and that could spur even a little bit more nearshoring going forward. And on your second part of your question, China, they are investing heavily in the region, like mostly FDI, not so much, in the financial markets, buying equities, but really FDI. So there's a huge port just north of Lima, which is the biggest port in the region being constructed by the Chinese. The Chinese have the Belt and Road Initiative, which is their investment all throughout the world initiative. So they can pretty much have sway and influence in various different regions in the world, and some countries in the region, are big recipients of these investments. And of course, what I think North American policymakers don't want is that Mexico is just kind of a last touch or last mile touch point for Chinese product, right? So the increase in the rules of origin that we were mentioning before, it's a policy that will try to counterbalance that. The US has tariffs towards China. You don't want Chinese goods circumventing the tariffs through Latin America. So this is going to be something to watch and see what policymakers are going to be doing on that front.
Andre, I wanted to ask a question about Argentina, because Argentina is a country we haven't discussed in terms of challenges and opportunities for their economy. Can you touch briefly on that, and also the election cycle in the region?
Yes, sure. So Argentina, the economy there has been kind of rebounding after years of very, very high inflation, right? They have the Milei government, which came to power. I mean, the election of Milei took place in October 2023. He came to power in 2024. So a big adjustment happening there, a big disinflationary adjustment, which is, of course, sometimes hard on the population. But Milei is very popular, actually. We did have some elections for the municipality of Buenos Aires, which are normally smaller elections, but investors were taking a lie on this because this was the first election post Milei got to power in early 2024, as we mentioned, and he did well. I mean, the party did well, right? His political movement did well in these June elections, and then you also have elections in October in Argentina. So the market had a huge rebound in 2024. This year, investors are taking a little bit of profits, but it's interesting to see Argentina coming back to investors' radar since this change of government that we mentioned. For the other regions, exactly, we have a bunch of elections coming up. We have the 2025 Chilean general election that's scheduled for November this year, 2025. The current incumbent cannot be re-elected. That's Gabriel Boric. He cannot go for a second term. And that's the same thing in Colombia. Gustavo Petro, he cannot go for a second term. The Colombian elections are in May 2026. And then the Brazilian elections are a little bit after that in October 2026. But here in Brazil, Lula, who is sitting president, he can go for a second term. So that's probably he try to go for his second consecutive term, right? He had two terms back in the early 2000s. So it would be his fourth term. So a lot of politics in the region as well, Rob.
Fantastic. Obrigado, Andre. Thank you very much for the call today. I'm sure our clients and our listeners will enjoy the podcast.
Thank you so much, Rob. Good to talk to you.
This podcast was recorded on June 30th, 2025. Be sure to join us for our next Research at Citi podcast, which features Max Layton, our global head of commodities, with a look at the current state of commodities in today's marketplace.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.